As we step into May, debt markets continue to navigate global rate uncertainties, inflation watch points, crude volatility, and evolving RBI liquidity conditions. While global central banks remain cautious, domestic factors such as fiscal cues, inflation trends, and policy actions are shaping fixed income sentiments. To help us understand what lies ahead in May for debt markets, we have with us Mr. Abhishek Bisen, Head Fixed Income at Kotak Mahindra Asset Management Company Limited. Welcome to the show, sir.
Hi.
Sir, how would you describe the overall debt market environment as we enter May?
Well, Asta, if you look slight uh, towards the back end of the last year and this year beginning, fixed income markets were not doing very well, and the returns were suboptimal. Post the war started, the fixed income markets have become suddenly very attractive, given the amount of volatility other asset classes are having. So I would say fixed income cannot be ignored in overall asset allocation. And given the pricing already happened in the fixed income, let's say the front end of the curve, which is trading upwards of 7%, it is offering great value for the investors who want some amount of stability in their portfolio.
So, with the US Fed maintaining a cautious stance, what does it mean for global yields and EM debt flows?
Well, so the kind of environment which we have, which we are in right now, it's very difficult to predict even what is going to happen next moment. The crude oil prices is the key driver for all the economic parameters, and frankly speaking, no one has any idea where crude oil is going to behave. As we speak, crude oil is trading at around 116, $117 a barrel, which is at a fairly high level, which any economy can sustain at these levels. So, given that any central bank would like to remain cautious and go very slow in such kind of environment where volatility can take away anything and everything, whatever you may do. So, very slow step is the order of the day.
So, we know Indian bonds have stayed range bound. What could drive the next move from here?
As I said, the Indian bond yields were elevated even in much advance, much before these event triggered, so which saved us from good amount of volatility. So, given which no one has any clue exactly this prices are likely to remain at these levels or likely to go up or fall from these levels. So, markets are fair amount of pricing in these levels to stay for some time around. But if the 116, $120 a barrel stays in for more than 3 months, I think we have some more we can see some more hardening of the yields. Well, having said that, front end will remain reasonably protected because it is pricing in some amount of tightening and it is not likely to happen so soon. Uh, two, 2 to 5, 2 to 7 year may see some amount of pressure because of these, but the longer end is again protected. Therefore, absolute front end and the longer end is the place to be in, and a kind of combination which we in technical term call as a barbell strategy will be one of the best suited for the investor with maintaining a duration of around 5 or 4.
So, talking about inflation, it remains in focus amid crude volatility. How should investors read inflation risks now?
Yeah, good question again. So there are many things which will go into inflation, and what kind of inflation the governments are likely to expose the economy to. Because if you observe, the government has already cut excise duties on the fuel. But having said that, still we are still way below the true market prices in the real economy. So the pressure is definitely there on the government to raise retail prices. At the same time, the monsoon related issues, heat related issues can cause volatility in the food prices. At the same time, all are supply driven issues which can create volatility into inflation. But having said that, a central bank may not be in a position to act on these issues because action of central bank will only slow down the economy but may not act on the inflation. And at the same time, these inflation will become the base for the next year. And next year, we are going to see much lower inflation, given the bases are going to remain high. So, while inflation risk is very real, but at the same time, the trade deficit and the BOP risks are probably at much more importance from central bank perspective.
Also, please tell us how important is RBI's liquidity management for debt market stability at this stage?
Well, you need to keep the economy going. So liquidity is the oxygen for the economy, and you cannot choke the economy at this point in time, where such harsh headwinds are already impacting the economy. Therefore, liquidity will be one measure which RBI probably will ensure that there is enough amount of liquidity for the economy to function in an orderly manner.
So, which debt fund categories are more suitable considering the current uncertainty?
As you rightly uh, use that adjective uncertainty, so in such times you need to remain in the front end of the curve because it is already pricing in reasonable amount of tightening from the central bank. But having said that, as I said, the longer end of the curve is already priced in. At the same time, therefore, investors who are long term in nature and would like to use this opportunity as an to make long term investment in fixed income or the portfolio also can consider, but should go in a in a SIP manner because if these situation persists for a long time, you may get some better opportunities over next 2 months.
So, what's your advice to the investors to remain disciplined amid short term yield movements?
So you to look in overall portfolio terms, fixed income was underappreciated asset class. But in the times to come, it is going to play a very important role in your portfolio. You just cannot ignore it because if you look at commodities, they're very, very volatile. Equities are very volatile. Given what is happening to the economy as a whole, uh, these oil prices have taken away good amount of savings from the investors. So this can have impact on the expenditure saving patterns and will eventually reflect into equity prices and fixed income as well. So fixed income will be probably one of the key generator in your key income generator in your portfolio. Therefore, you must not ignore it and choose as per your risk appetite. Uh, in volatile times, content is chosen because volatility will be the least and returns are decent. But having said that, the longer end also offers reasonable amount of volatility, reasonable amount of returns given the risk. So one can choose depending on the risk appetite.
So, going into May, what are the key triggers that investors should track more closely in the debt market?
At this juncture, there's only one thing which investors must track is the what is happening on the war front and the oil prices. But the issue is, even if the oil price is correct, we are not sure whether it is going to sustain or not. So once it sustains at a lower price for let's say around 3 to 6 months or 3 months for that matter, then only probably we may say that yes, the oil prices have come down for a long time.
Thank you so much for joining us and sharing your insights on the debt market outlook.
Thank you.
We hope this discussion helps our investors to navigate the month of May with more clarity and confidence. For more such discussions, stay tuned to Kotak Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.